Hi, welcome back to Channel 11. I'm Ken Shinoda, your host. Today is Tuesday, October 10th. We finally have a bond rally going on. Title of this month's review, The Bond Vigilantes Are Back, because we've had a sell-off that we haven't seen since last year, big rate move. We're going to look at that on the next couple slides. So basically making new highs across the yield curve, 2s, 5s, 10s, 30s, all on positive economic data that's come in. We've seen a massive de-inversion of the yield curve with kind of 2s relatively stable. You can see making just quite a little new high, right around that 5%. And it's really the long end catching up, thinking that the Fed's going to stay higher for longer. So now as we look at quarter returns, third quarter returns, just kind of a bloodbath for high quality fixed income. You can see on the far left-hand side, Treasuries down a little over 3%. Agency mortgages, the big loser, down 380. On the far right, in the yellow, is the U.S. index. That's down 320. IG down over 3%. And the winners are anything floating rate in this rising rate environment. And actually anything floating rate and risky has done better. Triple C levered loans up 7%. Triple B CLOs up 580. And some of the other parts of the securitized market, positive returns. Now let's look at year to date. Going to that far left, high quality fixed income, everyone thought the trade of the year is negative on the year. Again, agency mortgages leading the way, looking like one of the cheapest assets out there relative to their own history. We're going to look at that a little later. Index now down 240, corporate bonds now down 140. This is through last Friday, and everything floating rate up on the year. So floating rate, the place to be. Pockets of the securitized credit markets, also the place to be where the carry was high enough and the duration was low enough to offset the price declines related to the move in interest rates. So quite a different view on this page than people expected. Everyone was expecting high yield and bank loans and riskier credit to be down on the year, along with equities and treasuries and high quality pockets of fixed income to be the winners. Now, it's not as bad as it could have been. So last Friday, I asked my team, hey, go look back last year, 100 basis point rate rise in the 10-year, and then we saw a 100 basis point rate rise recently from the start of the year. And where is the return of the index? And last year through August, we were already up 100 basis points on the 10-year. We were up 200 basis points on the 2-year, and the index returned negative 771. Obviously ending even worse than that as rates rose even more through the end of last year. But now we started with yield this year. Many core funds started with a yield in the mid 6s. The index probably started the year with a yield in the high 4s, low 5s. And so you had some carry. Thank you, carry, for helping make the returns not so bad. Only down 3%. Another thing that obviously helped was credit spreads were widening last year and credit spreads are tightening this year. So a combination of having that carry and having credit spreads come in has helped generate less bad returns, if that's an actual term, less bad. But -3 could be worse, last year being obviously worse. And we still have a couple months of the year to earn carry, and maybe with some of the geopolitical concerns, rates may stabilize and come down a little bit. Only time will tell. This is a great look at how that carry can help you. We've looked at this slide before. This shows you the yield on the index, sitting at 554. Through last Friday, and above is a simple analysis of what happens if rates go up 100, what happens if rates go down 100, and from this point, given such high yield on the index, you can go up another 100 basis points and your return is only negative 70 basis points. So the downside is the higher yields go, the future downside gets less and less and less because you're starting at these high absolute levels. I know it's painful on the way up there. This last couple of weeks have been especially brutal, as it's just been this relentless sell-off. But now look at the downside versus upside, much better convexity profile, very limited downside next 100 basis points, and a lot of upside if rates fall 100 basis points. Throw on some spread product in here, and you can get even more than that 5.5% yield. Most core plus type portfolios are yielding 6 to maybe 7% for a core plus type portfolio that's got more credit risk in there. Yields on a 10-year look back. Now on the left-hand side in the high quality sectors, we're basically at the highest yields we've seen in over a decade. Some of the credit markets, spreads have not really widened dramatically, so we're not at kind of like those pandemic highs in yield that we saw in March of 2020, but We're basically on a 10-year look back from an all-in yield standpoint, looking very interesting across the board. High quality fixed income in the sixes. This is all high credit quality fixed income. And you can see IG, 5, 6 type percent yields. You go into the securitized space, easily high single digits for IG. You go into CLOs and you're getting floating rate assets yielding 6, 7, almost 8% for single A's. So tons of yield out there in the investment grade universe. This is why core plus type portfolios have such high yields. You used to have to lever high yield 2 years ago to get a yield of 5%. Today you can buy AAA investment grade bonds. Hey, you can buy the T-bill, which is what I know a lot of you guys are out there sitting in, waiting, saying, hey, I know I can earn 6 in this IG stuff, but T-bills are 5.5, but they may not be there forever. Something bad can happen. Rates, I know it doesn't seem like they'll ever go down, but at some point in time, the Fed will cut, the T-bill will not be 5.5. So, slowly trying to go out the curve and lock in some of these yields out more than 6 months, I think is a prudent thing for investors to do. Now, you want to buy stocks, you want mid-teens type returns, you can get that in the bond market too. You have to take credit risk, and now this goes across the different pockets of credit risk. High single digits, teens type returns, obviously not without risk. Triple C, anything obviously has risk, but there's plenty of opportunities out there as we're looking at the lower quality parts of fixed income. Now, what this is actually telling me is why do you need to lock your money up in these private debt funds that are 5-year type funds when you can get similar type yields in liquid fixed income, right? It's not the most liquid part of fixed income, but generally speaking, we're talking about assets that do get traded, bought and sold, as opposed to these locked up vehicles where you just get no liquidity. So maybe it's an interesting time to think about rotating out of some of the private into publics that have repriced dramatically. So what has caused rates to go up a lot? Well, it's been a culmination of a couple things, but really it's a lot of economic data to surprise to the upside. Started with that Q2 real GDP report. You have some positive retail sales numbers come in. You have services PMI still above 50. And then you had a lot of jobs reports that came in, better than expected, especially last Friday with over 300,000 jobs created. And so the red line is the Citi surprise index. And that started moving up pretty dramatically in May, and interest rates followed. And that's kind of peaked and it's starting to come down. So we're going into the end of the year. The jobs data came in solid on Friday, but a lot of that was, I think, hiring for schools that are back in session. And let's wait and watch kind of how things happen towards the end of the year, beginning of next year. Maybe that red line starts going down. That's a way for rates to peak out. The other thing that's happened that's positive for rates, maybe not moving much higher, is that the term premium has moved pretty dramatically, and inflation breakevens, which is the market's expectations of inflation, have remained pretty tame, even with this rise in energy prices. So I think a lot of the move is in. Could the curve flatten out to Fed funds, maybe go to like the low to mid 5s, kind of on the back end of the curve? It's totally a possibility. It could definitely happen. It's not that far away from here. So we talked about last time on Channel 11, I think we were kind of in like the 425, 430 range on the 10-year, saying, hey, this is the high end of the trading range. If you missed it last time, now is an interesting time to nibble. Could it go higher? Of course, it did go higher, but it went significantly higher, which I think makes it even more compelling if you haven't had that duration on. Do you need to go out to the long bond? Maybe not. But looking at the 5-year portion of the curve, even a little bit of 10-year exposure is probably something to look at when you're sitting at 17 plus year highs. So other interesting charts. TLT iShares 20 plus year Treasury bond ETF. A lot of you know this. Hopefully you don't own it because it's gone down a lot. But basically we got to and bounced for a moment off the 2009, 10, 11 lows, where you can see that was around kind of like $85-ish. And we broke through it. And I think we're back up, maybe touching it today with this rally. And the next support kind of sits at 80, which is obviously 5 points away. No, it's more, it looks like it's 81, 82. So it's a couple points away, but there's a lot of historical support at these yield levels. This is just a technical chart, not saying this is going to hold, but nonetheless, something interesting to look at of the different tools that we have in our toolkit when it comes to looking at rates. Now, with inflation break-evens basically sideways and rates higher, that means real yields have made a big move up, and real yields pressure equity prices. In the bright blue, that's the last month equity performance. That's September 23rd, and then we have year to date. So the blue is the month of September, basically almost red across the board outside of the FTSE. The NASDAQ almost down 6%, but still, after all that carnage last month, as bad as it felt, NASDAQ still up 30% on the year. The S&P still up 13% on the year, but kind of the value stocks in the Dow, the industrial type stuff, and then small caps almost negative on the year. So we know that the S&P and NASDAQ are dominated by large mega cap tech. And if you look at the broader economy as measured by maybe a more equal weighted S&P, that's sideways to down. Small caps are down on the years, and the economy is not those 7 stocks. The economy is, small business and some of these more small cap companies where a lot of employment sits. So we're watching that Russell 2000 as a barometer of kind of health in the economy. Commodities, kind of a mixed bag, down on the year broadly, still down 1% in September, down 9% on the year. Gold's kind of made a little bit of a comeback, but it's kind of flat on the year because it started high. Really, it's been a story of oil going up, and you can see oil's up about 10% on the year, more from the lows earlier this year. And surprisingly, inflation break-evens haven't really moved on this energy move. I think part of it has to do with the fact that the market thinks next year there's going to be more supply of oil coming or oil coming online that's going to help push prices back down. Going back to stocks, S&P 500 bounced off that 200-day moving average, found some support there, 4,200, moving up higher on lower rates today. And it's that Russell 2000, I think we continue to watch. This is usually leads the way down in the equity market, and it's been weak and getting weaker. So I want to watch this as a barometer for some of those riskier companies out there, because they're the ones getting squeezed by high interest rates. Chart we looked at last month on channel 11. I've been using it a lot with clients. This is from Albert Edwards at SocGen Permabear, but I like his work. This shows you on the top hand side, effective interest rates basically haven't really moved for the top 10% of the S&P 500. But for those smaller companies, they got to borrow short term. They got to borrow with bank loans. They got to borrow with C&I loans from banks. They're maybe borrowing at double-digit yields in the bank loan market, and you can see the cost of debt has gone up a lot for them. So watch those small caps. That the pain hasn't come through in corporate America through defaults. The interest rates are high, and that's going to eventually squeeze, I think, these smaller cap companies. So something, again, we're watching for. That's going to happen right at the same time as we think the consumer is starting to slow down. Consumer has thus far been resilient, but as we look at data related to the consumer, we're starting to see signs that maybe they can slow down next year. So first, it's the excess savings. This is on the left-hand side. This chart is now a little stale. New data was released this morning. We'll have to update this. Basically, some numbers around savings showing that maybe the excess saving is a little bit more elevated than this depicts. But nonetheless, based on this chart, you can see that the bottom 40% of households, right, bottom 40% of income, that's the blue line, has already depleted their excess savings from the pandemic. This is from the stimulus checks. The 40 to 80th percentile has depleted their savings, and really the only group that's left with excess savings is like the top 20% of earners out there, and they spend less of their income because they make more, so they have more savings anyway. So like the consumer savings is really driven by kind of that more bottom percentile where they spend more of their money on stuff. So we'll get the updated data. We'll see how that looks like. If you want to search for it yourself, Citigroup was writing about it today. And today's Tuesday, October 10th. But the savings rate, excess saving is going down. The delinquency rates are going up, right? Because people have less money to make payments. You can see this across all age cohorts on the right-hand side. You see it especially at the lower age cohort, age 18 to 29. And this is obviously a negative sign for spending. If delinquencies are going up, they're having issue with cash flows. So you got excess savings gone, delinquencies going up, student loan payments coming back online, right, which is gonna, again, should help slow spending down. On the far right-hand side, we see the increase in consumer debt, specifically targeting credit card debt. Credit card utilization is starting to go much, much higher, and that is also a sign that they're done with their savings and they're starting to eat in their credit cards. So we think that the best days for the consumer is probably in the rearview mirror. We saw some revenge travel in the summer of this year, and we think all these things culminating together is going to cause the consumer to slow down, and companies getting squeezed eventually will have to lay off workers in order to increase their profit margins, and that'll help cool the labor market. It's this stuff, the higher rates just takes way longer than people expected to squeeze through the economy. So we think you should stay patient on that front. Okay, well, what looks cheap? We looked at this every month. Agency mortgages, top left, cheap, getting cheaper, just can't seem to rally, can't get out of their own way. We've got a bunch of slides to look at agency mortgages because it's one of our highest conviction ideas. I know it's been in that upper left corner for the last couple months, there for a reason. There's a lot of headwinds that we need to get through for that spread to come back in. Everything's kind of widened. IG was down 40th percentile, some spread widening with the volatility out there. Same with high yield, was down low 40th percentile, got down to something like 380 spread on high yield. Now it's at 400 through September 30th. I think it's even wider through today, maybe around 420. So high yield definitely looking better than it did a month or so ago with some spread widening thanks to the volatility. But here we are with the what looks cheap report that we're showing you each month. And we're gonna dig in on agency MBS in the top left. This is a 10-year look back, agency mortgage spreads relative to corporates. You can see obviously that corporates have tightened a lot, widened recently. 98th percentile, that got as wide as 99th percentile. And so MBS has just a lot of headwinds. When rate volatility is high, mortgage spreads go wider. Mortgage spreads are very correlated to interest rate volatility. The supply-demand situation is not good. The supply has been high because the FDIC is selling $100 billion of bonds from Silicon Valley Bank, Signature Bank. They're through about 80% of that. There's 20% left. It's going to be done by Thanksgiving. So at least that one headwind will go away. And then the marginal buyer has been on the sidelines. Money managers are not getting bond fund inflows as we hoped we would, and banks are not buying because of kind of deposit flight and the situation with the yield curve. So high rate volatility, supply from FDIC, lack of demand, spreads push wider. What will bring spreads in? Well, you need the demand to come back in, you need spread volatility to go down. Basically, you need rates to stop going higher. So when rates stop going higher and rate volatility subsides, I think that will, one thing that can help spreads. The other thing is going to be when money comes back into bond funds, they start buying, and our money from the bank starts buying again. I think that's going to happen when there's more clarity around the Fed, and basically when the Fed cuts. When the Fed cuts, or the market thinks the Fed's going to cut, the market's going to expect the Fed to, the curve to now bull steepen. In that scenario, everyone in shilling and T-bills is going to fly into the bond funds and or stocks, and maybe just stay in T-bills, because maybe at 3.5, if the Fed cuts 200, that's still good. But largely speaking, that event will be the catalyst for the money managers to buy, for the banks to feel comfortable with the steep yield curve to buy. That's probably happening simultaneously to bad things happening economically, which is good for mortgages. That brings rates down, rate volatility down, and mortgage spreads to come in. It's almost like the perfect storm that took spreads wider is going to create the perfect storm that will bring spreads tighter, and it's a chain of events that likely all happens simultaneously. Again, the Fed cutting, or the market thinking the Fed's going to cut, which brings rates down, brings money back into bond funds, and gets the banks back into the marketplace. So mortgages look cheap to corporates. This is only 10 years. What am I trying to hide? Nothing. Let's go back 30 years. We're going to go back 33 years, actually, because I had a client say, well, mortgage spreads were always wider than corporates back in the early 2000s. We're okay. They were in the mid-90s when equities only went up before the dot-com bubble. Corporate spreads tightened. You can see that on the far left-hand side of the chart. And red is mortgages wide, maybe wide for a reason. Rates were higher, prepayment risk was higher. But even going back 33 years, we're 92nd percentile, meaning the spread on mortgages versus corporates, 92nd percentile, going back 33 years, nothing to hide. but showing that there are time periods when mortgage spreads are higher. But they're, maybe higher for a reason. It's higher because prepayment risk is higher. This shows you the dollar price of the mortgage index. It was at a premium for many, many, many years, right? It's at 82 cents on a dollar, 83 if I round. And you can see it never got quite below that kind of like 95-ish area going back through 1990. That previous chart we looked at was going back through 1990. So for much of that time period, especially in the early 2000s, right, where the mortgage spread was it's the mid 2000s where the mortgage spread was wider than the corporate spread, the dollar price of the MBS index during that time period was at a premium. So when mortgage bonds are at a premium, they've got more prepayment risk, right? If borrowers refinance, you paid 102, you get par back, you lose money. And so you've got that negative convexity. So spreads should be wider during those time periods, perhaps. When you're at $82 price on the index, your convexity is extremely positive. The risk of prepayment is so low because everyone is sitting in 3.5% mortgages. We've looked at this chart before, we'll look at it again. On the right-hand side, this is the prepayment risk of the index. It's usually always negative. You can see in the mid 2000s, it was -2, right? In that time period when mortgage spreads remain wide. And here we are, the risk of the MBS index, positive convexity. So low risk, low dollar price, wide spreads. I don't know how it gets better than this. And what helps mortgages is bad things happen. And most of your portfolio, you want good things to happen. If you own stocks, you want good things to happen, right? Largely speaking, other than right now, some people want rates to fall. You own credit, you want good things to happen. When you own mortgages, you actually want bad things to happen. That's when they shine. In the last 5 years, we haven't had many bad things happen outside of COVID. In COVID, you had the Fed stepping in. So mortgages, this is 5 years looking back, MBS, annualized equivalent, -85 basis points. Corporate bonds just crushing it relative to mortgages, positive 87 basis points. So 160 basis points of underperformance, basically, roughly, going back through time on an annualized basis, right? I mean, it's just mortgages haven't been able to win in this environment. Treasuries outperforming mortgages. Basically, what happened was we came out of QE into QT. Mortgage spreads widened just as they were extending. So mortgages went from being 2-year, 3-year type assets to being a 6-year asset, and spreads widening at the same time. Again, perfect storm. On the downside, meaning it's just the cheapest that it's been in a very, very long time, which we think means that when bad things happen, they're going to do well. This looks at the GFC. I kind of picked an arbitrary date in the middle of 06, and I said, okay, you own the different components of the index, and you're just chugging along through time, and then all of a sudden the GFC hits, and we go through the bottom in equities. And Treasuries will do the best. Mortgages do second best. The index as a whole did okay. And corporates don't do terrible. I mean, equities are down massively. High yield is down. Credit spreads are widening, but the duration in corporates makes the return not be so bad. Now, I don't want you to think I'm cherry picking the GFC, so we went back and we did this exercise. For every equity drawdown from 1992, December 31st, 1992, till today, roughly 30 years. And we said, let's look at these equity drawdowns, 0 to 5, 5 to 10, 10 to 20, down 20%. Treasuries do the best, bottom right-hand corner. Treasuries do the best, up 10%. They don't have negative convexity. But mortgages do second best because the spreads just don't widen as much as corporates into the risk-off scenario, where spreads are widening. In that scenario, high yield's obviously doing poorly, down 9, still better than stocks. And corporates do okay, low single-digit returns. They did a little bit worse during the GFC because spreads went wider than they normally do. But that's the case for mortgages. It's a downside scenario hedge. It's like Treasuries, but in the meantime, you get paid spread. That spread is near decade-long wides relative to its own history. It's near decade-long wides relative to corporate bonds. So we think it's a really important time to take a look at them as an asset class. And they kind of sit at the belly of the curve. The duration of the MBS index is like 6 years. So you're not going all the way out and kind of into the long bond, which I know everyone's terrified of. So it's kind of in I think, an interesting spot on the curve and one of the most interesting assets to look at. Now, this is just a fun chart, just because mortgage rates are almost to 8%. Maybe they won't quite get there if rates have peaked, but if we go higher on rates, mortgages could go higher. And so I was just looking back and saying, hey, when's the last time mortgages were 8%? It's a long time ago. It's early 2000s. And you can see we charted this against the NASDAQ. And the NASDAQ basically peaked in the beginning of 2000, started falling. That was the top. And then mortgage rates peaked afterwards because we were in a tightening cycle, trying to restrict the economy, trying to get the excess out of there. And they just went down with the stock market at that point in time as rates fell with the stock market. Not saying that that's going to happen, but how does it look like today? Well, the NASDAQ had been on a tear. The NASDAQ peaked, has come down, and then rates are moving higher. So it looks eerily similar to this chart. I don't love overlay charts, but I'll just leave you with that interesting tidbit of looking at the NASDAQ versus mortgage rates. High rates across credit and across debt is restricted to the economy. That's why there's Fed officials out there and governors talking about maybe we're done because the move in long-term rates is restrictive and maybe we don't need to hike short-term rates again. So it's going to be an interesting end to the year. We've got some geopolitical conflicts going on out there right now. And so, good luck to everyone through the end of the year. And these are our thoughts right now in the fixed income markets. Thanks, everyone, and have a great month.